So the first thing I got to say is I can really appreciate the prior panel that starts talking about statutory spending limits on CCC and cash flow needs subsequent to the fiscal year. It's a very nerdy thing, but I appreciate it. There's maybe like a few of us that really get into that. And great panel, and now I'm your intro act to another great panel. So while I have been set up to provide you lots of conclusions, I will probably give you very few conclusions. I'm an economist. I'm going to tell you what I see and leave some of the give you a little bit of interpretation and then tell you a little bit about some of the considerations. This was a really difficult, I think I've said this every year for the last 5 years, difficult presentation for me. And why would I have done it 5 days ago? Right? It would not have been fresh. So let's talk a little bit here. I'm gonna, if you throw my presentation up. So we talked a little bit about farm income, and the previous panel said several pieces that you will in fact see in some of the things that I talk about. I would normally show you my ERS colleagues' farm income report, and what it would say is farm income is expected to rise sharply in 2025. And I didn't show that because I think it gives the wrong impression about what we're dealing with within the ag sector. If I take that rising farm income and I subtract direct government payments, the economic assistance for previous years, and I subtract cattle, farm income's down, not up. So I think it's important to at least to start out with the fact that when we look at this, here's our crops and our livestock cash receipts that my colleagues at ERS put out. That's the lowest crop cash receipts since 2007. And as you go through this presentation, the one thing I want you'll see me repeat again and again is cash receipts is only one part of the output price equation, let alone some of the input price parts of the equation in profitability. Okay. So again, I'm going to start with talking to you about basically a tale of two sectors here. This is the crop sector. This is what you're looking at in terms of cash receipts. So it's not an anomaly where we say something like, oh, soybean receipts are way down, but they're offsetting gains in other crops. That's not the case. You look through this chart and you can see very consistently declining receipts in corn, soybeans, fruits and vegetables, well, a little bit up, but not substantially so. Sorry, fruits, vegetables down, wheat down, cotton, a bit of an anomaly, but cotton down as well too. So you're talking about across the board, not great prospects on the crop side. So when you think about farm income, you've got to break it up into its pieces to see what's going on and where the stress is coming from, or where, as our guests, the panel said, the previous panel said, where diversity might be helping you. If you've got corn, soybeans, and cattle are probably carrying the farm right now. Right? Otherwise, there's a lot of losses. And so here on the other side of the animal, for livestock, basically things looking up for most livestock categories. So, folks want to say, what's the one number that tells me what's going on in the ag sector? And I would argue it's not overall aggregate farm income. That's not the number that tells you what's going on, because it's insufficient to provide you with the details, I think, of the very distinct difference between cattle and livestock. Let's talk a little bit about acreage as well, too. My colleagues on the panel will follow up, I know, with a lot of great detail. So I'm going to lay a little bit of the groundwork here and say the farmers made some decisions this spring in anticipation, perhaps, of difficulty in marketing soybeans. We see a big swing in acreage into corn acres. This has other implications as well, too. Think about just the sheer volume difference between an acre of corn and an acre of beans. So you got the most corn planted since the 1930s. That produces much more volume if you need to store it than beans. You got a storage issue as well on top of all of that in terms of what you're producing, what you're going to store, how you're going to move it out the door. But farmers clearly, I think, making a decision that I'm going to plant some corn, there's less risk in doing that. Okay? So that's kind of the first part of that. Then the second part of it is, they were mentioning the WSDA price, what the WSDA price is going to be, ARC and PLC payments. I'll actually show you a bit of that. My group is the group that does the WASDE report in cooperation with my colleagues at NASS. Corn prices, bean prices, but you look down this sheet and you notice pretty much downward pressure on crop prices across the board. So that's where you are getting that falling cash receipts. You're getting the falling cash receipts because almost across the board you see falling prices. I very specifically put the two summarization. You see the one that says 2010-11 and 2013-14 and then 14-15 to 19-20? It's because we go through these price spikes in history, and we can talk a little bit about how this one might be different, but you go through these price spikes, input prices jump along with those prices, and then they come down, and input prices tend to trail them down, but eventually come down. So you got the price spike of 10 to 14, and then you got the low point in 14 to 20, and then I'm kind of telling you how prices are evolving coming out of this latest price shock, kind of peaking in 2022. Okay? So we see these price spikes, input prices jump up with them. Historically, in the last few, we see input prices steer, eventually decline. We go into several periods of a very narrow margin. We've gotten to that very narrow margin pretty quick, I would argue. And I probably, for those of you who are here, I talked about this last year and probably the year before that. Because here's the, and this one, receipts are falling and costs are rising. So here's my calculation. You can see this is an input price increase in 2025 from the prior 5-year average. And some of you might be going, well, that fertilizer price isn't that high. But remember what happened to fertilizer prices in 2022, which is in my average, when Russia invaded Ukraine, right? You had very high fertilizer prices over that period of time, and yet over the 5-year average, we're still talking about those prices being higher. So maybe a little bit different than what we've seen in the past is we're not seeing the same moderation in those input prices as commodity prices turn sharply lower. And here's a chart, and this is one I've showed in the past to try and illustrate those price spikes. So you have one there in the 7-8 period, and then you have one, as I showed, around 10, 11, 12. In 2012, remember, we had the very significant drought across the Midwest. But you can see there, when we look out into the future, we've had our output price spike, the green line, and the input prices spiked with them, but now they've turned back up, even as commodity prices continue to fall. Again, they're not following that normal pattern of they're slow to come down, margins get squeezed, and yet we kind of get into a very narrow margin period. We're getting into a negative margin period pretty quick. So it's hard, I mean, and the difficulty for me in talking to folks about this, not you all, but talking more generally to folks, is trying to describe what this actually means. I took some information from Central Illinois corn production in their budget sheets, and this includes some ad hoc payments, and it looks at margins across Illinois, Central Illinois, high productivity farmland. It looks at all in, what's the margin, and you can see there that you got a negative margin in 23, in 24, a forecast one for 25, and unless things change, a pretty negative margin for 26. And amongst those four margins, they're the largest negative margins in that 25-year period. Okay, so whatever else is going on from a margin perspective on these crops, you've had several years of eating up any liquidity that you've built up in the previous few years, or, quite honestly, ad hoc disaster assistance payments are in here, but you're still eating up liquidity that has been injected. Beans, roughly the same story, and you're saying beans neither appear to make as much money nor lose as much money on average, but still, same story with the margins, right? The last few years have been very poor margins. Okay. So let's talk a little bit about trade and some of what else is going on. This is outstanding sales. So there's two features of outstanding sales. So this is sales which are on the books for soybeans for this current marketing year. And you'll notice a couple features of this graph. First, outstanding sales have been declining for a while in terms of outstanding sales at this point in the same period in previous years. And you'll notice the absence of anything in red, which is the Chinese are not buying. So there's two features. Obviously, the Chinese not buying is a feature of why outstanding sales are lower. The other feature, which I find odd, and I'll tell you why I find it odd, is it is not odd that you see it declining as prices of commodities come down. The book, as we call it, tends not to fill up as fast if you think prices are going lower. What's the hurry to put sales on the books if you think prices may go lower? So it is perhaps not surprising that we see the book decline, but are U.S. beans not a bargain for other buyers besides China? I know there is a lot here. This is a seasonal graph, a calendar seasonal graph, from January, obviously, through the whole year, and it's the U.S. soybean price less the Brazilian soybean price. So who's more expensive? If it's positive, the U.S. is more expensive. If it's negative, the U.S. is cheaper. And there is deliberate seasonality in this. Deliberate seasonality. We become cheaper when we're harvesting, and that's our 6 months of the year. And then it shifts, and then the Brazilians become cheaper. But this is dominated because China is needing to buy year-round. That's what develops this seasonality. This year, if the Chinese are not buying from us, and they're only buying from the Brazilians, both we and the Brazilians now need to spread out our export program to all year. This is that same chart, but now I'm showing you 18 and 19 during periods of trade friction. You can see how much of a discount we had to be in 2018 to move those beans. We are not there at the moment. We are not running that discount, but we are still a discount. It is the price that has to do the heavy lifting. This is one I'm sure I will get comments on how wrong I am, and I love it. So this is kind of the futures market look ahead. So those are all the contracts going into the future. But this is Chicago. This is Chicago. And the Chicago signal on prices said, you should sell your beans and store your corn. But we got to remember basis. We're a ways away. If we've got some North Dakotans here, they might comment upon what their basis for soybeans is, and that's not what the market is telling them. So we are seeing some basis differences based upon the reorientation of the trade of our commodities, right? We've got to spread them all around all year for beans and to different destinations. The Chinese don't buy our corn at the moment anyway, didn't last year, are unlikely to this year. Less of an effect there, but for beans, at least in Chicago, it's saying sell the beans, store the corn. And that's not what it's saying in other places in the country. China's ranking as our export market. It's varied between 5th and 6th, as low as 6th, as high as 1st over the last 5 or 6 years. Implications for our exports at any given time. Still, but you look at this and you also say, we've got 2 nearby trading partners that have increased their overall imports of U.S. agricultural goods over those same time. Okay, so how this trade forecast for 2026 turns out, obviously important. When we do these kinds of analyses, we don't project or speculate on any deal that may be made. We don't do that. That's not the way we operate. So this is like status quo when we do these exports. So think about that and when you're talking about what's the upside or downside potential. This is status quo where we sit today. The other, and I'm using these slides as a prop here. I'm trying to cover a lot of ground here. So this one to me, I think we've talked a little bit about biofuels, but there are lots of other policy issues going around that can affect short-run demand. And when I think about short-run demand, I think about in the next 12 months. And then medium-term demand, next 2, 3, 4 years. And then things which are a longer-term demand, which are building some fundamental additional demand in the marketplace. And biofuels, for example, is one interesting one. I know folks were talking about the RFS only giving, the secretary mentioned that imported feedstocks only get a half a RIN. So they only get half of the compliance credit that a domestic feedstock will get now under the new RFS. And in addition, those volumes are rather aggressive. So there's a short term, this is a next year and the year after type of demand increase. There's the 45Z tax credit potential put out by Treasury. It's not a volume changer, but it is a potential cash flow changer for producers who are able to access or negotiate for part of that tax credit. Exports for biofuels were record high last year. So there are lots of things in these types of policy levers or policy action or market changes which can also change the outlook. Let's talk just really quickly a little bit about livestock. Again, completely different story. I didn't think we could get that high on cattle price forecast. I didn't think we could get that high on the cattle price for 25 either, but here we are. We've got very strong cattle prices. I think that is benefiting things like the hog market and broilers. Turkey market has had to try to right-size itself, trying to find a natural balance in the number of turkeys to balance with demand, and so you see a lot of swinging around in turkey prices. Egg prices, if we do not get HPAI, no HPAI is assumed going forward in this, we'll finally start to see some egg prices returning to a more normal level. Okay. Cow-calf returns. You heard the Secretary say that no heifer retention payment is being considered this morning, okay? But there's a lot of money to be made, perhaps, right? I have told folks, never has the saying, a bird in the hand, meant more than it does today in terms of retaining the heifer, right? You got that heifer, she'll bring a very high price if you sell her today. Are you confident that you can retain her for 2 years, make that income stream work? And part of it is we've had amazing beef demand. I would argue that there's that the elasticity of demand, their responsiveness to price, seems to have fallen and separated from other meats. People like their beef. But how much of this is also underlying economic conditions? What's the risk? What's the risk of falling demand? What's the risk of passing on that retained heifer and trying to capture that value longer run? Well, that's the big question. And uncertainty maybe has a role here. We will see if we turn within the next 12 months. At least profitability is quite good. And here's just a general impression one as well, too. And there's a lot here. But this is like the top one is choice beef. The next one is ground beef. And then you've got eggs and chicken breasts, etc. So this is all of this protein graph. And beef really has separated itself from the other meats. We went through a period where egg was no longer the cheapest protein. We went through a period where turkey breasts rose. But you notice that beef prices have separated themselves from the rest of the meats. While dairy prices might expect to be a little softer come the end of 25 and into 26, those lower feed costs will keep them somewhat, will make the feed price ratio still be favorable for those dairy folks. Okay, let's talk a little bit about, so with all that in mind, I'm going to show you some macro stuff and some overall sector stuff. So this is farmer sentiment index out of Purdue. Now, you can see overall that farmer sentiment remains elevated. It's declined recently. I think that that's not surprising. When you get the margin squeeze, we are at harvest now. We're looking at those margins becoming a reality as we're harvesting that crop, but it remains elevated. So is this a signal that farmers think that there is upside, longer run? This is the farmer sentiment index, clearly higher, clearly some optimism that there's some good potential out there. Land prices. Land prices continue to, even if modestly, land prices continue to rise. Is this an indicator of optimism? Is this an indicator of something else? What's driving land prices higher if we've got such poor crop margins? They're not exactly tied together, of course. What's driving this? And when folks think about, as we've heard, talk about, is there a possibility of intervention? What should that intervention look like? This is the kind of question also, intervention of what are people's expectations about intervention? This is part of this discussion that the last panel was talking about as well, too. This is total value of production of the corn crop, and this is at those prices what ARC and PLC will add to that income. Okay? So when they're talking about it's a pretty good hedge, this is the graph that they are showing you. This is a graph of what they were talking about. So as prices rise or prices decline from this point, there's an offset. When the prices would go lower from where our WASDE forecast is, PLC would offset some of that decline. As they rise, you don't get the full value of the price increase relative to the overall cash flow because the payments decline. The problem with this is there's several ways I think you need to think about this. One, those are on base acres. The orange is on base acres. If you don't have base, you don't get that payment. That's the first issue. The second issue is you get the blue one when the corn is sold. You get the orange one October of 2026. So do you have a cash flow issue? If you've got a cash flow issue, you don't get that payment until October of 2026. And that's what they were talking about, some portion of the discussion of pulling that payment forward. That's been something that's been floated. But this is what they're talking about, it being an offset. But it's an offset in 2026. You have to make it to 2026, October of 26, when that payment comes around. And they talked about a rebalancing of base acres, right? The addition of those base acres. That's for crop year 26, which means it doesn't arrive in your payment until October of 27. Okay, so is the current situation we find ourselves in a cash flow issue? Is it an overall an economic intervention issue? Those might also dictate how you would approach this. And there's a lot going on here, but this is kind of the cycle we find ourselves in at the moment. And I don't know, again, the question is we're on a part of this cycle where I could argue if I looked back in time, things are not as bad as they have been at certain points in history. But are we on a cycle where this continues to occur? Are we going to find ourselves in the same position next year at this time? Okay, so you start out with income is lower in that first graph in the upper left. And then the need for borrowing increases. This is all from the Kansas City 10th District Federal Reserve. The right one shows the need of borrowing increasing year over year. And then you go down to the one in the lower right-hand corner and repayment rates start to decline. And then you go to the one on the lower left-hand corner and it says banks are increasing their collateral necessary. And then it says you are here. So in December of 26, you've got to make, that's when the discussion with your banker begins in earnest about whether you'll be able to do this for another year. So there's timing of the intervention. There's what those payments will look like. Is this a temporary cash flow issue that needs to be addressed? Is it a long-run injection issue that is this year sufficient? Is this a multi-year problem? Do you need to deal with other demand issues? And now you get to hear from a bunch of really smart people who will answer every one of those questions. All right?